Good morning and welcome to the webinar. Okay, I always get asked at such times, market is at a high. Okay, isn't it too risky to invest? I think even we find that, let's say, the small caps have gone up very sharply. Okay, do you think we are going to see a correction? So there are always points of fear that one may have at such times when as soon as you hear okay, market is at a high. Right? The only point to keep in mind is sometimes what is a high is a little bit relative, right? So that's so before we actually I normally do this and come back and run a survey before we get in, and I give my points of view, right? So if we can run a bit of a poll. Okay, right at the beginning to say, where do you think the Sensex will be 3 years from now? Okay, thank you. So for the participation in the poll, I think we can share the results. Yeah. So almost like it's interesting. 89% believe that the market is going to hit a lag. The Sensex is going to hit a lag, which is interesting from something like that 64,000 plus or minus where it's been hovering around. Okay, so that's a reasonable expectation, and I guess a fair share of bullishness that I can see from the participants out here. Yeah, maybe one thing one could have had is also probably a lower number to see whether it's been muted what the views or whether it's really an aggressive. Yeah. So we move on to So one of the points, I think, can we stop the share? Yeah. So one of the points that we look at is exactly what I was saying, that every time you see markets correct, right? If you just look at this chart, it's a reasonably upward sloping curve, right? So, and if you see, there have been almost 30 times that market has fallen 10% or more. Okay, so it has fallen such that it's 20% or more, and in the last 25 years, and it's always bounced back stronger, and the falls look like a best investment opportunity later, right? Because at that time, many times, the feeling is, oh, it may go down further, or there's a feeling of fear which grips us. So that sort of stops us from maybe taking a bit of a good decision in terms of investing at those points of time. But this is what the history says. In fact, if you look at even how the index has done, right? It's a staggering 640 times, because index starts at 100, okay, and the Sensex at 64K will be something like 640 times in a little over 4 decades. Okay, so if somebody just invested and slept over it, would have made phenomenal money. So that's a big picture that we want to sort of convey, that many times when we look at markets at a peak and stuff like that, yes, we like to book profits. So maybe the previous time we did take some money out. In fact, prior to COVID, in October to December of 2019 on our PMS as well, apart from on the wealth side where we did profit bookings, on the PMS also we took cash calls. We need to move to financials, etc., when we were uncomfortable with the valuations. Okay, but today, valuation wise, we are far better. Valuations in 2019, end of 2019, was almost like 29 times was the PE of the Nifty, and today we are back to something like 21, 22, and we've been hovering in that range. Okay, and a lot of it is because the earnings growth has been very strong. So the point one is making is, yes, it's not like the earlier time, because now 20 months have passed by. So it's, even though it feels like, okay, we are maybe at a high, we are at an all-time high, the fact is we saw that same level almost like 20 months back, and we are where we were, right? So from here we think that a larger move on the upside also is definitely possible, looking at the past and also looking at how we think earnings can grow for companies. Yeah. So the other point where I just wanted to bring about is, even if we look at bear cycles, which are sort of larger, right? So you will find that the falls have not been small. Okay. In fact, COVID, of course, has been 38%, but that is not the largest fall. A large size fall is almost like 50% plus, right? Which we saw in 2000, and we saw in something like the 2000, 2001, and we saw the similarly in 2008, period of time, right? So that's something which, one saw. Of course, 2008, we saw a very low number right in October of 2008 itself. So it was, while you say 14 months here, it then went up a little, came down further. So we looked at for the maximum time. So you'll find that each time the index sort of, when there were large falls, it's fallen an average, anywhere between 9 to 18 months or so. So which is why in sort of March of this year we took a certain call, which and we published our annual report. I'll share that as well as we sort of go forward. Okay, so this was the report that we came out with, and keeping in mind, looking at market cycles, looking at the P ratio, looking at interest rates, and how long a typical fall has been, we gave a buy call, we gave a contrarian call, the end of March, suggesting that, and this is what we said, that, index is likely to deliver 20% plus returns, for the financial year, right? And if you look at it now, we have a good part of it already done. Okay. Of course, when we said 20%, we said 20% plus, because obviously one will want to be a little conservative while we sort of give some of the numbers, right? So that is something. So whatever is happening now is in line with our expectation. Interestingly, the second thing that we said, because at that point, small caps were sort of the most volatile, and large caps were doing sort of far better than small caps when we made the call. Okay, and our point was mid and small caps are likely to do much better, than large caps in FY 23-24. So that was the thing that we had given. Even the specific section where we also captured different market cap stuff and relative valuation, from that standpoint, which is a chart that we are seeing also on the right hand side, which was part of the report. Okay, is and from that you will find that the small caps are looking even more interesting, right? So if you see the second chart, the divergence between large caps and small caps, it had means large caps is so much better and went to the top, say, orange line. Okay, and so the fall was reasonable in relative, or the relative performance versus large caps was so much negative, versus so large caps, small caps versus large caps, right? So this is a period when we actually came back and said, we think small caps will also do better. So, and like I said, what was the backdrop at the time of the annual report? Like I already explained, there was persistent inflation, rising interest rates, slowdown in the US and other advanced economies. We were facing the Adani issue, which was there for India. I mean, that came out in the end of January, and in Feb and March, it was running at its peak. Then you saw also the US banking crisis, the fall of Silicon Valley Bank. Okay, and there were subsequently other banks also had to be, supported. Okay, Credit Suisse, the prices spread a little bit to Switzerland and Europe and stuff. And again, Credit Suisse had to be supported by the government, even though in the past the Switzerland government has said that they would not support, a bank in a difficult situation. So there was a lot of this negativity when we sort of gave this call, and we were in a bear cycle at that point of time. Like I said, Nifty also had fallen. from its peak, of March 23. Of course, not as bad as what we saw in, the COVID time, but yeah. If you looked at the EPS growth also were reasonable. So in that period, while if you looked at it from something like, the previous 20 months, because earnings growth also was there, technically we had a bit of a markets were much better. In fact, at that period of time, I know some in some of the groups, people were, very negative also because FIs were pulling out large sums of money, right? So between October 21 to October 22, FIs had pulled out almost like $27 billion, okay, from India, which was one of the largest outflows that we saw. Interestingly, in that period, of course, what supported was Indian investors were putting money in, and which is why the Nifty return was negative 8.6. It was not so large in terms of negative out there, okay, because they saw some bit of Indian money coming in. So where are we now? So because I want to set a context, okay, from the report, and when we gave a contrarian call, things were very negative, and still we said yes, this is what we are expecting from the markets, okay. And so today we are in a much better place. Even Adani Enterprise, we've captured the share price there. It has seen a reasonable rally from its lows. The US banking crisis, I think now you're not finding too much of news around. Okay, of course, some of the banks have fallen, and it is now more or less contained. Market also not seeing risk. The Dow also started moving up, and continue to move up. That is something which is there. You also found volatility in equities has sort of reversed, and you have a interesting that while large caps moved up 9%, the small cap indices moved up 20%. Okay, so till date from April to now. So that's that is something which, if anybody heeded our advice, would have seen a fantastic, almost like less than 3 months, 20%. Right. So that is one aspect out there. FIs also have changed course. That's the other interesting part. And while people were debating me, at that point when the report came out saying that no, but FIs are sort of really negative. My view was that at some point there's an inflection point, and actually we look at extreme levels of FI flows, right? So, and from extreme levels, actually, we have found that the reversal also is pretty sharp, and that's sort of what we are seeing out here. FIs have actually now put in 40,000 crores for this financial year, right? And interestingly, even the Nasdaq and global equities have sort of come up in the Dow, including the US. Okay, of course, we did have a negative view on the Nasdaq even before 2020, which is why broadly we stayed away from the FANG and the Nasdaq, etc. Because looking at market cycles, one felt that they are at a risk of a larger market fall. So now I still think that one needs to be a little cautious about Nasdaq because my view is there's an eerie feeling that it's very close to 2000, 2001, and which is what happened. The Nasdaq was the leader of the rally. At that point, you also had, say, basically .com rally that was there. It was driven by .com, and which is closer to what we have now, which is a digital rally. Okay, and the digital stocks really went through the roof in that period of time. Okay, and interestingly, the index fell, and it came up very sharply again, like what we are seeing now, and it fell short of the peak, and then eventually when the Nasdaq fell, it fell from 4,800 of the index to almost like 800 to 900. Okay, so the fall that one saw was 80%. Okay, so I'm just saying at this point of time, I want to be a little cautious on technology stocks, especially the ones which are rallying and the .com ones. And of course, the Nasdaq index also has a good weightage to them, so one is being a little cautious on that. So this is something where, so coming back into, so as we go forward, look at the data, what is it that we are seeing? Okay, we're saying that average bull cycle performance, and this is something. So answering the question is 20. We've seen a 20% rally in small caps, right? So the question is it already over, right? Is it worth investing right now, right? So typically we don't like investing into a rally after it's matured, and we think that the small caps is probably still at an early stage. So if you see it's interesting that typically when you have a bull cycle, the Nifty or the large cap index doubles. Okay. And when you see a rally of the small caps, typically, it goes up to almost by 220%, which is, if it is, let's say, if you had 10 lakhs in it, you'll probably see something like 3.33 lakhs. So that is something is what it shows. So we believe that we are still at the earlier stage of it. Of course, like I said, based on relative valuations and our study of it, okay, we believe that mid and small caps will sort of continue to do well, and so that view sort of continues where we are. Interestingly, now if you see large cap for 3-year return is say about a 10%. Mid cap is about 14.5%, and small cap is 15%. One view that we had, okay, is even at the beginning of this decade, and probably before the beginning of this decade, is one felt that India would be the star of the decade, okay, and of course that was again a big contrarian call, because the previous decade, ending 2020, was possibly a reasonably bad decade for market performance in India. Of course, if you looked at the COVID fall time, you probably would have done worse than even a debt fund. Okay, but if you looked at, say, December 2020, right, you would have seen that equity may have just surpassed debt returns in that period, because that is a period where India saw what we call as a deleveraging cycle. And that's a period when, almost like 4 AAA rated companies went to default. And companies, when you're saying deleveraging, they reduce the loans. Okay, so all companies reduce loans, partly triggered by banks being very conservative in terms of lending, and partly because of stress on the balance sheets of some of the companies. So which is why in that period when there's a deleveraging cycle, typically the economy doesn't do well. Okay, and markets also don't do well. So that was a period where, so our point was, after a deleveraging cycle, typically after a cleanup, our view was that a lot of the write-offs have happened, and we end up seeing a leveraging cycle. So in fact, that is one of the key reasons why we believe that India is going to be the country of the decade. It's interesting that now we are finding that the Morgan Stanley report said exactly the same thing, and why this is India's decade. And one respects Morgan Stanley a lot more than the others because they are much deeper in India, and they have strategists like Rhythm Desai, who have been who are part of the global team, okay, and the homegrown from India, deep long-term studies of the Indian markets, right? So of course the others also, interestingly, Ray Dalio, one of the best investors globally, and has, and very, very well respected, consulted by governments, also has said that the potential of India is enormous. So we think that and the point one is making is one also wants to give you the big picture, because one shouldn't get lost in trying to save a small downside and miss out the really large upside that comes. So one is again categorically saying that our view is that the upside is going to be very large, which is why typically in the past, like in 2007 of October, November, we did a very large profit booking. We have not done something now. We did something in October of 2019 to December of 2019, when we felt that the P ratio and the markets were sort of a little overvalued. But from here, we believe that this is a period for India, and equity markets is something that one should participate in, and one can also take a little higher level of risk in this period. And just to give a little bit of perspective of, let's say, from last year, what has happened, because, like it was little volatile in the last year. Inflation was at peak. Now that is sort of moderated and moderated pretty well, actually, for one's comfort. Interest rates also started, have come down. Okay. And the first view you will see from actually the yields in bonds, okay, which are traded on a day-to-day basis. Maybe some of this you will start seeing in bank FDs and all of that, over a period of time. There's a lag for that to happen for you to see it, in say FD market. US recession, the fears were that it's a very strong expectation of US recession. Okay. And right now the view of a recession has come down. Even though personally, my view is that I think the US is going to struggle for almost like 2 decades. So I have had a very negative view on the US and its economy, because the whole point is like what we said of India, that we had a deleveraging cycle. I think after a great period, I think the US will go through a period of deleveraging, and in that period, there will be actually pain on the street or for the common man as well. And so I'm a little bit, conservative on investing in US equities at sort of this point of time. I don't think that you may not see a large correction from here, okay, but other than possibly on the Nasdaq, okay, but at the same time, you may find, like in the case of China, China was the star of the previous decade, and this is the second decade of pain, that China is going through. And if you actually look at their long-term stock chart, it fell down after 2008, and from 2008 to now, so it's been a good period of time. We are down where we were. There were spikes in between, but we were down where we were. The other is again crude, etc. Range bound right now after having spiked up. Global equities are rebounding. Domestic markets are at fresh highs. So I think there's a lot of positive feel that we go forward. Again, like one said, that small caps really go up when they go up, and which is why my point. And so when we are looking at what is the opportunity, right, one feels that at this point of time, small cap is the place to be, right? So that's a specific call that sort of one is giving. In fact, on that basis, we also work to launch a fund, and which we started off at the beginning of this month, and we plan to run it for a limited period, because so if you see, the rallies for March 20, how steep it was. Similarly, each of the periods of time, and there may not be too many corrections in between, right? So and typical rallies, if you see, like the 6 months in 2006 is 1.6x, actually is a part of possibly an even larger rally. So up to 2008, right? If you see right from 2003 to 2008, again, maybe that's much larger, maybe 6-7 times the index sort of ended up moving up. Okay, so this is my point, that when small caps move, they can really move, and they can move for a larger period and percentage that what we expect. Okay, and even from a equity valuation models, etc. When we look at Nifty forward earnings by 10-year GSEC deals, again, all of them are at levels which we think will continue to expand there and sort of give strength. So if I see large cap, mid cap, actually the lower it is, the valuations are better. So which means you can see that the large cap and the mid cap valuations are now at the average of the past. Okay, so the blue line. Okay, so whereas if you come back and see, and the table which is down as well, saying that where is it versus long-term averages, right? This is where it is. But if I look at small cap, and this is also the reason why we are saying small cap is trading at a reasonable discount to its long-term average. Okay, so that is, so typically you will find that pullbacks happen, and which is where we are saying. In the past, I've chosen not to focus on products, but I think sometimes customers came back and said, and investors, why don't you give something specific to sort of take advantage by that? Maybe I'll just spend some time a few couple of slides on what we tried to do to take care of such an opportunity. We launched a Super Value Aggressive, which is a small cap fund. We have a very successful Super Value. Super Value is a mid and small cap fund, and even if you look at in the performance wise, the period ending December, we were, it was the only 5-star rated fund. So it's either been 5-star, 4-star, for a period of time. Okay, and it's been right at the top in terms of great performance. And what has helped it is because we worked on a methodology to how do we focus on identifying multi-baggers. That's something that we really focused on over the last 4 or 5 years. And once we started looking at small caps as a focus area, right? So that is what we have in mid and small cap, we want to replicate in a pure small cap and maybe micro cap fund. Okay, with the thing the point one is making also, once the small caps are discarded the most at the first signs of uncertainty, and they outperform the most, at the first signs of stability. That is why we are suggesting what we are suggesting. Okay, at the same time, it's important to have quality names, and you will find that if you have quality companies, the differential in terms of returns can be very, very high. So you can see the top quartile average is something like 37% compounded 10-year growth, right? Phenomenal, right? If one is able to look at quality names, that's something that we do with a very detailed process. Maybe next time I'll spend a little more time, maybe next webinar on how the process that we follow and how this framework can spend a little bit more time. But the point is, what is this multi-bagger framework? We're looking at two segments of return, right? One is that the company itself does better. So there's growth in the business and earnings should at least double in the next 3 to 5 years. Okay. And the second part is we look for ones where the P multiple also can expand. There is a valuation for the same, say, the earnings that, the market is respecting that company more. And then we find that there is an inflection point, and where one is able to identify those companies which are at a discount to industry leaders. Right? Once the broader earnings growth comes up, the emerging leaders see a re-rating, and one sees, okay, valuation improve as well. And so this is what we've seen in Super Value, which is, like I said, a mid and small cap fund. Okay, like IRCTC, when we invested in the company, it was at a 335 initial PE. That PE went up to 105 when we exited the company. Right? So similarly, so that gave us certain growth trigger. Apart from that, the earnings also grew up 2x. So totally a combination of these two factors, right, ended up us seeing something like a 6x return. Similarly, Neogen, right, when we invested 30 PE, it went up to 75 PE, and earnings growth of 2x. So both again combined. So similarly, so that has been just not one name, but a number of them. And a couple of these stocks we've also not exited. Okay, so I would like to make a disclosure that we continue to hold, KA Industries in various portfolios. We continue to hold APL Apollo also, because where things have sort of not gone out of the stratosphere, we sort of try to sort of look at it. Okay, and we may still hold some small part in GMM Fondler. So that is something which is there. And what are we trying to do with the small caps is this, we identify names where we, like, a paints company, I cannot disclose it for compliance reasons. Okay. So it's a paints company, and say the current multiple is 40 times, the sector multiple is 79, right? So it's trading at a 50% discount. So with an earnings growth, we think something like this. So similarly, maybe we're being a little conservative here, but won't be surprised if we say anywhere between 3 to 6x in various names, in whether it's a wires and cables company, or it's, fashion retail, or an NBFC. Those are things that we think that will sort of do well. I was saying that, just a quick roundup of where our schemes have performed. If you see, Super Value has delivered 38%. Flexi has delivered something like 31, and, underserved, which is a small cap, okay, has delivered something like 50. So you can see that, small caps can sort of deliver a larger percentage return. And PMS Baran has, certain rankings and stuff like that, and those have got, good thing for us. While one is suggesting all of it, okay, I still believe that, it's important to also look at the other side of things, right? So it's very important to also look at the risk. Okay. So while we are suggesting a small cap fund, okay, it's only for investors who can take that higher level of risk. Now, and this is where I'll give you an example of a person who came to me, and because when there was a message that was sent out, on the launch of the fund, there was interest shown by a person, right? And he was actually a retired, and so on studying the details of it, one actually told them this is not a fund that you should be investing into, right? So you have to be careful. It's whatever the returns are. I'm saying, you need to be clear that your risk profile overrides, okay? Because a lot of the time we don't look at it, and then money makes us, anxious, right? When we take excess risk than what we can actually manage. And secondly, small caps also should be a part of your portfolio. It should not be your full portfolio, right? So even if you have the risk appetite, I'm saying that you should not be investing all your money into small caps, right? So even though, however good it may sound, we have to be watchful that, there could be periods of time when volatility may be there, and volatility may be large enough, and we may get nervous and, get pressured at such times. Okay, so the macro risks also, are there. Yes, there are a lot of good things happening, but like suddenly we saw the Ukraine war. Can we see there's some bit of tensions around China and Taiwan? Okay, we believe that the slowdown in the US is likely to happen. Okay, banking in US and Europe. Okay, if there's something that deteriorates there, the good part is today it seems to have been managed well. But if it sort of blows over, then that's something to be watching about. And central banks have been tightening, and if there's any further tightening and that continues on a global basis, most of the central banks are still keeping an open mind and seeing both ways. Okay, and not committing to an easing of interest rates, or not also increasing interest rates for most of them. Okay, but then that is definitely something. If things deteriorate and inflation goes up, you could see some impact out there. Domestic, yes. Will there are concerns around elections. There are concerns about El Nino impact, and how it impacts the monsoons, and will it result in a demand slowdown. FI outflows, if it happens at an EM level, right, then will somebody continue to put in money if emerging markets, they have a negative point of view? And, whether some of the infrastructure spending that is, planned for the economy gets postponed. One doesn't expect at least this to happen, because it's an election year, and, the government will want to sort of keep the economy up and, continue to do its bit. In fact, the other thing may happen that, you may have certain policies, which are populist, which are maybe negative for the economy. That's always been a fear. But again, their election, I mean, the budget is passed, so typically you don't see any large measures other than the budget. But that's definitely something to watch out for. In summary, I think like just to summarize, yes, we came to the contrary view at the beginning of this year. Our outlook, was an expectation of 20% plus return on the financial year, with a bias towards mid and small caps. Okay, we already have seen a spike, but we still believe that we're at an early stage. And yes, one is hoping that because there's been a very sharp rally in the short term, we are already seeing a little bit of a correction there, and I believe such corrections should be taken advantage of for deploying money. Okay, and sort of mid and small cap rallies typically have lasted 2 to 4 years in the past, so it's not a really short term phenomena that we should be saying that, okay, in 2.5 months, market has gone enough, so we should not be investing. And small caps, we believe, are the sweet spot. And so we have come out with a PMS, which is a super value aggressive, to take advantage of this opportunity for investors who have a higher risk appetite, right? So that's very, very important to keep that in mind. In fact, we are doing it only for a limited period, so we are doing it a little differently from industry. Since we came out with a good time in terms of, what's the time to invest, right? And, markets have seen an inflection point from that point, and mid and small caps have started to rally. We feel that we only want to keep this fund for not more than a couple of months, okay, or maximum maybe 3 months. The reason is, and this is a little different from what industry does, right? So the fact is, a lot of investors look at past returns and then invest, okay, and a lot of the growth in the assets of fund managers, of asset management companies is very high at the peak of the rally. Okay, and the issue that we have then is that those investors don't make money, right? And probably they lose money and they have a negative experience. So, which is why we are saying, even though it may be negative to us as an organization to grow our AUM, okay, we are saying that we will keep at least a small cap fund. The others I don't mind, because we may not see so much of volatility there, and we'll probably investors can ride through. We'll also take steps to how to manage risk, etc. Okay, but that is something that we believe that we don't want to keep it open for a longer period of time. Okay, so that's something to keep in mind. And of course, we also looking at it and seeing that if at some point we are uncomfortable with valuations, we may even choose to close down the fund and maybe put that money into some other, say, a large cap fund, or give it back to investors to do what they want to do with it. So that is the second aspect that we are saying it, but we will look at it only when we are really uncomfortable with valuations, and you can see that the worst thing is if small caps have, say, gone up 5x, you don't want to get out at 2x, right? So you want to ride it as much as possible. But I'm just saying that if we really feel uncomfortable at certain point, extreme points, at that time we may come back and see whether we want to return money to investors. Okay, and like I mentioned on the risk, small caps are a higher risk, they are higher volatile, okay, even though they give better returns. So keep in mind your risk profile before you invest in a fund like that. Okay, and not only with right horizons, but I'm just saying outside as well, if you want look to put it into some other small cap fund and stuff like that. That's something that one would do. Yes, we will continue to be looking at markets, and we've always been contrarian. And if there's some point that we think, like I said, markets are likely to fall or correct even in the short term, we may de-risk the portfolios like we do at various points of time. Okay, but and in line with our philosophy of delivering a superior risk adjusted return. Okay, so basically disclaimers out there, and if you have any questions, I think I want to keep sufficient time for questions from your side.
Yeah, thank you, sir. So we'll begin the question and answer session. So Mr. Karnam has asked about global inflation and the aggressive rate hikes by US. So many were expecting a crisis like the 2008, but then Sensex ended up moving continuously. So do you think this is a bubble buildup, or do you think this is going to be a proper bull cycle?
Yeah, so if you see, actually, the Nasdaq and the US markets have seen a reasonably large correction out there. Yes, I did mention that I am negative about the US specifically. For most part of it, the US has a significant impact on global markets. Okay, and anything so like they say, when the US sneezes, then the world can catch a cold, right? So that is something which is there. But however, there are points when some of these diverge, okay, and there are points. So, and I think history and data gives us a way of looking at it. So, and I said, for example, 2001, 2000 is the closest that we see, right? So if I went back and saw that, two things happened. One is, interestingly, while Nasdaq fell 80%, the broader indices in the US did not fall as much because people went and reallocated some money back to the non-technology companies. Okay, so that is there. Yes, there are impacts, but never an 80% type of fall. So there could be large, there could be even a 25% correction and stuff like that if something like that happens. Okay, but the good part is, like I said, even within the US, forget about outside, the fall was not as large. Yes, it 2001 impacted Indian markets. If you remember, you saw that the data out there. Okay, but that was also because technology had a reasonably large percentage in the indices at that point of time as well. Okay, and but yes, if US has, I think technology companies may face some bit of trouble out there. So, but keeping various factors in mind, I believe that there's going to be a cycle and it's going to subsequently trigger a huge emerging market rally. India will be one of them. Okay, and India probably will be the most beneficial because we are one of the few economies who've already seen a deleveraging cycle in the previous decade. And most of the others are actually at a point when they'll probably see a deleveraging cycle, as we go forward. Yes, the other interesting areas like Europe, right? Europe also had seen reasonable, deleveraging over these years, and for a very long period of time. So you may find that there may be some of these markets may sort of come back, So I'm not. So long story short, there could be volatility, but keeping in mind where the Indian markets are, where the Indian valuations are, where interest rates are, etc. I think India will reasonably do well, and one doesn't want to go too conservative in such points of time because I think the move up that we expect is far larger. Okay, so even if there's a volatility at this point of time, I think we are suggesting investors, ride through the volatility because the future is more bright.
Yeah, thank you, sir. So the next question is, what is your view on investing in the gold and at current point in time?
Yeah, so if I'm negative on the US a little bit, I'm negative on also the US currency. In fact, so what I think is for most NRIs believe that say the markets or let's say the rupee always depreciates. Okay, actually, if you go back and study history, the rupee depreciates in spikes. Okay, and if you see after a large spike, you find the rupee sideways for anywhere between 2 to even 11 years. Okay, so if you actually saw from 2001 and you saw in 2000, after 2008 as well, okay, some 10, 12, 2012, okay, the rupee would have been broadly where it was. Okay, so I would think that we will see a period like this where the rupee may sort of appreciate for a period of time and sort of may also say sideways for a longer period of time. If in worst case, even if it doesn't, go up, I think it's not likely to depreciate. That's the point. And in a situation like that, where the dollar depreciates, gold actually does very well. Okay, so the end, if there is some bit of pain, in the US economy, then gold again, typically does well at such points of time. Okay, so that's my view that a long term, I think gold will do well. The short term, there may be volatility that you see, and those are points where maybe one can look to buy.
Right. Thank you, sir. So the next question is, how do you see the risk of 2024 elections and with inflation rising almost over, so will the RBI start cutting rates?
So there were, I think, two questions that you brought in together. So so I think some of these are like monsoon performance is like astrology. So in fact, somebody shared me also a particular thing, and I said, I don't. I look at numbers. I don't look at such charts. Okay. Uh, so yes, there could be an impact. In terms of the monsoons. Of course, right now I don't think we are seeing too much of an impact now. We need to see sort of as we go forward with more data sort of coming in, whether there's a bit of a negative impact of monsoons. So I'm not seeing monsoon as a big risk right now. 2024 election also, I don't think we have an option and there's going to be a change there. Okay, so I would believe that even there you'll probably see continuity of the current government. Okay, of course, with both of the risks involved there. But the good part in all of this is that, as we've seen in the past, the economic policies have seen continuity, right? So between, in fact, a lot of the successful policies right now, if you go and see where did they start, many times they may have started in the previous government. It's very good that the current government have taken it to a completely new level, right? So and credit goes to them for some of that. And so even if you see like Ruchir Sharma, etc., have specifically made notes of how they've said how things have changed in the last decade, right? So few things that we have really liked is continue to maintain fiscal responsibility. Okay, not taking any short-term populist measures even on the eve of elections. Also in pressing times like COVID, managing fiscal very well, right? Maybe giving a lot of dole outs, which or what looked like dole outs, okay, and giving positive vibes and stuff like that, while actually there was not too much of, other than maybe a significant money that is spent on vaccinations, right? Like what other countries did, they gave free money to people. They gave a lot of money went in, so this government actually did not take any of those measures there. So I'm not seeing too much of a risk. Inflation actually has been falling if you study. Okay, so so that and I believe over a period of time we'll probably see interest rates also come down.
Thank you, sir. So the next question is specific to the investor. So he's a 64-year-old and is asking for what is the right market cap and what is the right time to enter.
Yeah, so one or two things. One is that the thing is, it's very difficult to time the market. Okay, so and you need to look at the broader view, because many times we get stuck in the smaller view and we miss out the larger move that comes. Right. So I would think for somebody like this, like who's at a 64 year, first of all, we look at your overall asset value and only take a higher level of risk for the money that you may not require, so to say. I've known some retired people who just dividends take care of their monthly income, right? So if you are like that, there's no problem. You can be even a full equity person also, right? But if not, if you need to sort of watch your asset value and see that, okay, how do I think, then you need to look at some equity to take care of inflation, right? And that can be anywhere between 15 to 25% in my view. Okay, and that part of it, again, you can use conservative options, you can use hybrid funds, you can use dynamic asset allocation funds, etc., to even for that part of the exposure, so that you're not honestly getting stressed out by market movements there. And for somebody who like this, I think right now markets are already moved a little bit. Maybe do systematic transfers or phased investments, or invest in a hybrid fund at this point of time. So I'm not sure August 23 is a good time or not, but whenever there's a correction, it's a good time. Okay, so take advantage of that, because at times we put a number in our head and say, okay, you know what, I'll invest if markets go down to X level, okay, or I'll invest in this period of time, or I'll say that okay, I'll wait for elections, right? So what may happen? Market is always predictive and looks at the future and and discounts the future. So, and if market has reasonable clarity on certain things, it'll already happen today, not waiting for tomorrow, right? So I'm just saying that in worst case, if you want to be conservative, then you can do a systematic investment up to say August or so. But I would think that there's no point in timing the market too much at this point of time. See, we've also taken contingent costs. We've also got out of equity, but I think this is not a time to do too much of averaging out, in my view, and the earlier one sort of gets in, the better. And now one expects a little bit of a correction, so those things can be actually used to enter the markets if you would like to. But yeah, but just keep in mind your overall asset allocation.
Yes, sir. So the next question is, how are the reversal of interest rate cycle going to help the small caps? And then, how long can we look to invest in them for returns, better returns? That is one.
See, with small caps and markets as a whole, like I said, typically it lasts 2 to 4 years in terms of a cycle in terms of small caps. But we'll have to keep on watching. And because suddenly the valuations really go obscene, then those are times when we sort of step back and say, okay, let us then take some money out and stuff. So yes, I would say broader 2 to 4 years, but continue to keep watching for any negative conditions and see what is it that one wants to do, and more importantly, if valuations go excessive, right, and keep in mind that typically it's not unusual. In fact, the past we've even seen say 50x P ratio in small caps. Okay, it's not unusual. Okay, so one needs to look at past data and then see what's the level that one sort of starts looking to take money out and stuff. Okay, but a broader basis, maybe 2 to 4 years.
Yes, sir. Thank you, sir. So the last question is, so what is the minimum investment required to invest in the small cap fund? And then what is the product profile and how to reach out to the team?
Yeah, so that I think if somebody will, reach out to you. Okay, so you can just ping us as well. Maybe what we'll do is we'll also follow up, because there are a lot. I'm seeing the number of people coming back and asking for it. We'll share maybe the details, and one can also sort of come back in case of interest there. Yeah. So so on the PMS, the minimum is 50 lakhs. Okay. Of course, that 50 lakhs can be in multiple strategies, and we could also keep some bit in, say, mutual funds on the PMS platform to sort of take care of a slightly smaller, amount of investing. Because yes, we also don't want you to suddenly put a much larger sum of money than is appropriate for you, right? So if you are in that condition where you're not sure, please, reach out to us specifically on that, and we will try and analyze it for you and say what may be appropriate for you at this point of time, right? And we a little unlike some of the others, like I told you, even this particular client who came back and I said, don't invest in the small cap fund, right? So my team, in my view, will keep that integrity to be able to come back to you and tell you, what is maybe an appropriate number or whether you should invest or not. So if because yes, like I said, small cap is higher risk.